Hi, my name is Jonathan Roth, and welcome to Risk Hedge Video. I'm joined today by Barry Habib. He's the CEO and founder of MBS Highway, and he's the right guy to have on the show because Zillow and Pulsonomics just named him the top most accurate forecaster when it comes to real estate. They gave him the Crystal Ball Award. So Barry, congratulations on the award, and thank you so much for joining me.
Well, thank you very much. Appreciate the chance to be here.
Well, I really wanted to talk to you this week because, as you know, it's been in the news a lot over the last few days. Janet Yellen is clearly going to raise interest rates this month. Wondering what your take is on what sort of impact that's going to have on real estate in the United States.
So it's multifaceted. So think about, first of all, from a historical perspective, the impact on interest rates. So if you were to take a look at the last full hiking cycle, which was between 2004 and 2006, the Fed hiked rates rather significantly from a level of 1% to 5.25%. So they did it in quarter-point increments, 4.25%. What's very interesting is, for the most part, mortgage rates behaved quite well, and real estate did exceptionally well during that period of time from 2004 to 2006. Now, the last two times they hiked rates, we saw at the end of 2015 some volatility and some negative reaction in the interest rate environment surrounding the Fed rate hike, but then interest rates improved rather significantly. In 2016, almost a carbon copy until we saw this huge rally in the stock market, which really weighed on the bond market. Money came out of stocks, out of bonds and went into the bond market, and that weighed on the bond market. So interest rates were already in the mode of going higher for several reasons, because globally rates had gone up, inflation, which is the enemy of interest rates, started ticking up, and because of money going into the stock market. Now, rising interest rates have, on occasion, been a little bit of a headwind for real estate. But for the last 45 years, the average interest rate that we've seen on a 30-year fixed rate mortgage is 8.25%. Today, it's about 4.5%. So even though it's risen, significantly from its lowest levels, it's still a favorable environment. And real estate so far, even though rates have been higher, on the purchase side of things, has been quite resilient, and the purchase market remains really, really strong. So here's the negative. If the hikes cause the stock market to, from these extremely lofty levels, to decide to make a protracted retreat, then that wealth effect, people who are thinking about purchasing a home that suddenly watch their assets decline, they may now have some hesitancy to purchase some real estate. So that could be the adverse impact of this. That said, I don't think that this will be extremely negative for stocks. Maybe they do have this invariable pullback, even if it is somewhat significant for a correction. I don't think it'll have that big of an impact on the psyche of individuals looking to purchase real estate. When you look at the overall environment, the levels of inventory are so darn low. We hear it everywhere. I speak around the country. My finger's really on the pulse. The biggest complaint is such low inventory. And at the same time, the demand is very high. First-time home buyers coming in, millennials really coming into their own. The level of, now 33 years is the average age of an individual first-time home buyer. If you look at the birth charts, 33-year-olds coming into the market each year for the next 9 years will be greater than the last year and actually exceed the highest levels in the baby boomer generation. So I think demand is going to remain really strong.
That's fascinating, especially the bit about millennials, which I'm going to ask you something about that in a moment. But first, I just want to get your take on this. I'm going to assume that you think that Yellen's going to raise rates by 1/4 point. Where do you think she's going on that?
I do. I think that makes the most sense. You have to remember that of the 10 voting members, 4 of them are rather quite dovish, including some of the leaders of the pack, the Yellens, the Dudleys. And then you have 5 centrists, and you only have one real hawk, and that's Harker. So when you think about the makeup of the voting members of the Fed, they're more often than not going to lean dovish. I feel that they pretty much have to pull the trigger on this hike, and they've telegraphed that, as you've so correctly anticipated, because inflation has been ticking up. It's been that way on the CPI report, the Consumer Price Index, which I personally feel is a lot more accurate than what the Fed prefers to use, the PCE, the Personal Consumption Expenditure. because the CPI, having already been above the Fed's target of 2%, has a greater weighting to housing expense and out-of-pocket medical costs. The PCE, which in my opinion foolishly doesn't look at those as closely or at all in the case of out-of-pocket medical expenses, is something where I think the Fed kind of kids itself. But even those levels, thanks to higher oil prices, thanks to just some natural increase in inflation, are very close to the Fed's target, with the headline now being 1.9 and the core rate being 1.7. It's close to the Fed's mandate of 2%.
Okay, so we just talked about. No, go ahead.
I'm sorry. Sorry. By the way, the jobs numbers have been rather impressive as well. You can argue about the mix of jobs and whether they're as high paying, but the fact is we've got a very tight labor force. As evidenced by people holding on to their workers, we see the numbers at extraordinarily low levels for initial claims. We're anticipating some solid job growth in this Friday's report, about the 180 level. Then the unemployment rate being now sticky under 5%. It's a tight labor market, and the Fed's got to wonder if and when we're going to start to see some wage pressure inflation.
Well, there's no question about that. Now, a question for you, because obviously, as you said, the current makeup of the Fed is pushing things in maybe more of the gentle rise up. Everyone knows that the Trump Fed, whenever this begins to materialize, which is going to be fairly soon, may change things. What do you see things? How do you see things shaping up as it pertains to once Trump starts getting some of his people in the Fed? Where do interest rates go at that point?
Well, certainly the Fed will have something to do with that, but the natural market forces will as well. So I think that naturally, forget if the Fed even did a thing, I think rates will gradually kind of move up in a gentle manner. Now, if the Fed becomes overly aggressive in hiking rates, it's interesting because if they're a little bit too aggressive and they start to drain money out of the stock market, interest rates could actually decline. If they're perceived to be really combating inflation to where inflation moves a bit lower, interest rates could actually, as crazy as it sounds, decline in an environment where the Fed is hiking and where they're get either close to the curve or ahead of the curve. So that's possible. But that said, it's interesting with Trump because sometimes he tends to be the Trump who gets things riled up and talks about how critical he's been of the Fed. But then as president, maybe it's not in his legacy's best interest to be the president that appoints such a hawkish voting Fed group that they really take the punch bowl away perhaps a little too early on the stock market or too severely on the stock market. And then that spirals into, we're in a very long recovery period, so to speak. And you don't have to be a genius to forecast recessions. Recessions will come. The question is when. So do you now kind of spark the next recession potentially by hiking too aggressively, by appointing a Fed that's too aggressive? So I don't think when push comes to shove and really making the appointments that he will lean too hawkish on it, perhaps a little more balanced, but I don't feel that it would be in his best interest, nor would he be advised to go too hawkish. Perhaps not as dovish, but not too hawkish, my opinion.
Well, I think it's a pretty good one, too. So I want to go back to something that you talked about before, and that was discussing the impact of millennials on the real estate market. And I think that's something that most people do not understand. Could you unpack this idea for me that as people reach a certain age, and millennials are this generation that's coming up right now, that they are going to continue to push the real estate market in a positive direction?
They certainly are. And some people think that millennials have given up home ownership. They haven't. They just look at things a little bit differently. Look, in the 60s, it was not uncommon for people to get out of high school and get married. So, around 20 years old and having children at 21 or 22, this was not uncommon. Today, millennials, it's not uncommon for them to be 30 years of age getting married and 32, 33 to start having children. And while you can't stereotype everyone, and not everyone fits into this basket, it's not unusual to think that a large segment of the population follows a pattern of get married, have kids, and then find a home to suit those needs. Well, if you're waiting longer to get married, longer to have kids, you're just going to probably wait a little bit longer for the purchase of a home. And never mind the fact that they may have been scarred from the events of the housing bubble, which means that maybe they should just wait a little bit longer anyway. But I think that they are going to continue to be the driving force and come in very strong. Just about a year ago, the percentage of first-time home buyers purchasing homes was just 28%. Now today it's 33%, so it's really moved up, and I really see that as the millennials. Some people will argue and say, well, it should be closer to 40%. My answer to that is just wait. It will get closer to that level. The thing of it is that millennials do take a little bit longer, but they are cropping up. Interesting, just personal story. I produced a show on Broadway, Rock of Ages. I was very proud of it. And we were the 27th longest running show in the history of Broadway. It was a very sad day for me when we closed the show because I thought we had a really phenomenal show and we just didn't have that strong traffic to keep it open any longer. And I looked at other shows like The Lion King, and I looked at Wicked, and I would ask the question, how are these shows staying open when we're, my humble opinion, so much better, And someone explained it to me beautifully. They said, Barry, that's because every year there's a crop of 13-year-old girls that need to go see those shows. And I look at that for the housing market, and I look at the crop of 33-year-old first-time home buyers coming into the market every year, those millennials, being larger and larger than the previous year. And I say, wow, this demand is going to remain very strong. And by the way, after that, it doesn't fall off a cliff. It levels out, and it levels out near the highest levels ever of baby boomers, and we know what they did. And one other point on this is that when we take a look at those millennials making purchases of those homes and coming to the market at 33 years old, I think that they're going to be a very well-qualified bunch as well. So I see this housing market remaining strong. Remember, inventory being so tight, and also the foreclosure inventory, which 4 years ago there was 1.65 million foreclosure homes for sale. Today it's 328,000. So you think about all that inventory sucked out. It's a recipe for supportive pricing. I hope it just doesn't go too high, but I think it's going to be supported. It's not going to go down. It'll probably go up at a good level to where people can make a lot of money in real estate today.
Well, just before I let you go, I would be remiss if I didn't ask you, what is the hottest real estate market that you'd be looking at in the U.S. today? The one that real estate investors should really be paying attention to?
Wherever, I don't know what the reason is on this, but wherever marijuana is legal. I don't know what the correlation is, but all of those markets, they're on fire, okay? They are
really?
Absolutely.
Wow.
Yes, they are on fire. I don't know what I've been joking about this, but it's true. It's, it's Seattle, it's Portland, it's Denver. These are the hottest markets. So, again, I don't know if there's a correlation there in California now, but, people are lighting up and buying homes, I guess. But in all seriousness, there are so many really strong markets around the U.S. right now. The Northeast is lagging a bit, but that's kind of healthy. I think that certain areas of California need to take a breather. Denver needs to take a breather, but I don't think they're going to be bad because the inventory levels are so low. Florida looks like it's going to continue to be a good market. Arizona will continue to be a good market. We're seeing most of the country doing pretty darn well, and follow jobs. If you look locally at the jobs, if the jobs are doing well, you're probably going to see a good real estate market.
So in other words, smart real estate investors should take a look at marijuana's coming up in the ballot upcoming and buy real estate there now, and you're probably going to cash out.
It seems to be working. I don't know why.
Become a Risk Hedge insider for free by visiting riskhedge.com. Each week you'll receive vital analysis on today's geopolitical, financial, and social risks. Just visit riskhedge.com today to become a Risk Hedge insider.